My take: the road ahead. In a week where surprises were overflowing, one of the biggest surprises, from top tier economic indicators to company earnings and policy decisions from around the world, was how steadfast financial markets were. Number one, economic indicator. Figures showed that the US economy shrank in the first quarter, the first contraction in 3 years. Consumer sentiment is at a metaphorical abyss for now. Some of this gloom was countered by unequivocally positive figures coming out of April's non farm payrolls report. Two, corporate front. With uncertainty surrounding tariffs, several leading global firms cut or declined to give forecasts in their first quarter earnings. Yet, the overall tone from these calls last week was positive, and investors have consistently bought the post Liberation Day dip. Hence, the huge price swings in individual shares and assets. However, in the US at least, there's little evidence that trade uncertainty is prompting companies to lay off workers or jack prices. Not yet, anyway. Three, policy making. There's a growing belief that US President Donald Trump is backing away from his more belligerent tariff threats and that a more receptive Washington is closing in on several bilateral trade deals. Tensions with China may even be cooling too. But this is only half the story. US stocks closed the week with gains of up to 3%. The dollar advanced, treasury yields rose, and the VIX index of US equity market volatility eased. On the surface, a strong week for investor in sentiment and risk sentiment. Remember, what today is saying is that the economy is a lot stronger than people thought and a lot more resilient in the face of all of these tariffs and fears about tariffs. But for markets, that suggests choppy waters ahead rather than plain sailing.